Welcome to today's episode of MMA Municipal Bond Review. I'm your host, Lynne Ashminov for BestCashCow.com. Today we have joining us Tom Doe. Tom is CEO and founder of Municipal Market Advisors. Tom, it's great to have you with us.
Lynn, nice to be here with you.
Tom, as someone looking to invest in the municipals market, what is the current condition and where should someone be considering an investment?
It's a particularly difficult time for individual investors to enter into the municipal bond market. Many are seeking the municipal arena because they're concerned about higher interest rates, higher income tax rates, and so they want to shelter their earnings. Unfortunately, so many people have done so that yields are extraordinarily low. So investors should maybe take a little bit of time to see if rates rise a little bit before they enter into the market. If they have to come in, and some people just can't stay in cash, is that they might want to extend out between 10 and 20 years on the yield curve, which may seem a bit long to many individual investors, but it's where they're going to get some value. The shorter maturities where individual investors are often most comfortable maybe are an area where a lot of other investors have already preceded them, and that's driven yields to very low levels and not much return.
I see. Now, your response was oriented toward maturities, values, and timing regarding interest rates. However, headlines have been oriented toward credit risks. Most notably, a recent Barron's article cited the risks associated with large pension liabilities that could be heading toward widespread default. What's your firm's perspective on the risks associated with investing in this sector?
Well, we think a lot of these credit articles that have come out have been akin to yelling fire in the movie theater. There's no question that state budgets are stressed, that high-risk sectors such as land-secured deals, casino financings, corporate issuers who can make access to the municipal market or usually have lower credit ratings are risky areas and ones that investors should avoid. However, Moody's, the rating service, just came out with a study of default rates from 1970 through last year, and the default rate for a municipal security, investment grade, which is what most individual investors will pursue, is 0.03%. Wow. So that's extraordinarily low. So as long as an investor stays in the investment grade area, we think that they're pretty safe. You mentioned the Barron's article, and this was something that really was of a concern to us because there was a hedge fund manager who was cited in it, and we strongly believe that many people who are, especially on the hedge fund side, are trying to spook individual investors, really to scare them to liquidate their tax-exempt holdings and then buy them themselves at a cheap rate and take advantage of a shrinking amount of tax-exempt issuance this year, as well as you were just saying, an expectation of higher income tax rates.
Oh, wow, okay. Well, there are many ways an investor can access the municipals market: direct bond purchase, mutual funds, separate managed accounts, ETFs. What do you recommend people look to?
Well, I think pursuing these products really comes down to the amount of assets you're going to commit to the marketplace. Traditionally, mutual funds have been something that's appealed to individual investors because the diversity, just as you were mentioning, asking earlier about the credit risk, investor feels comfortable by being involved in investment in a wide diversity of holdings, and so that gives them protection. Unfortunately, those values of a municipal investment, like a stock investment, can go up and down, so that sometimes when someone's looking at their portfolio, as they might have in third or fourth quarter of 2008, all of a sudden see a tremendous drop in the value of their investment and lose sight of the long term. So if they have, let's just say, less than $100,000 to invest in the municipal market, then they might want to look at a mutual fund. They might want to look at an ETF, exchange traded fund, and that's been popular. In fact, a very fast growing sector of the municipal market. About $6 billion in assets are spread across 14, 20 funds. In fact, even for my father, who's 85 years old, I invested in a high yield ETF, which worked out very well and provided liquidity and diversity. The individual bond purchases, which can be done again in the investment grade sector. Is a very sound way of investing in municipals. Some people get afraid that it's going to cost them a lot to do the transaction, but in this day and age, through some of the trading platforms and the larger mutual fund houses that offer a brokerage capability, they can get a diversity of holdings, and they can get reasonable execution. But that's really for investors who have $500,000 or $1 million to invest. And when you get up then above $1 million, then you're really talking about hiring a specific money manager to help you with your investment.
I see. Well, you seem to downplay the credit risks associated with investing in the municipal sector. Are there other factors more critical to investors in municipals?
Well, we believe that this year in 2010, that the greatest risk to investors is liquidity. And the reason I say that, again, I mentioned the Moody's default rate study, very low credit risk as long as you stay in the investment grade arena. If you get into high yield, that's a different situation. But what we've seen in wake of the subprime crisis is there's limited capital that the banks are allocating toward the municipal bond area. And as a result, that's reduced the amount of liquidity to be able to trade. And so if I wanted to sell my municipal bond holdings, it could be difficult. Now, on the mutual fund side, or the money manager, when you hire a professional to help you out with this, they face a similar type of constraint. And it's always been very difficult for the municipal market to explain to investors, here I have something that's very safe on a credit perspective, but it doesn't have a great deal of liquidity. And so that becomes kind of a non sequitur, kind of confusing idea, but yet it exists, and so investors have to be aware of it. So even when selecting a money manager, rather than focusing someone who's hired a great credit team to review to kind of protect against default, you really want to have someone who has built up an operation who they can access liquidity and get your money for you when you need it.
Right. Thanks for all this great information. We look forward to future updates.
It was a pleasure.
And thank you for joining us. I'm Lynne Ashminov from BestCashCow.com. Have a great day.